So starting from that point, and throwing away the gut feel approach or the relying upon other people to make your decisions for you and blaming them, and trading without any consistent mechanical objective approach, I started with something basic like trend lines. Now, I'm going to start with showing you a couple of examples with the help of Rick, and one in particular, I think will demonstrate better than anything the message I'm trying to give you. I happened to be in Chicago maybe about a month ago, and at that time the book had just been received by a number of people, and someone in the audience who I think was a trader on the Chicago Mercantile Exchange said to me, "Look, I use trend lines, and I'm not seeing a lot of trend lines in your book where there should be trend lines." And I didn't understand the question. And he asked it, and he rephrased it, and I said, "Well, geez, the trend lines are drawn a certain way, and not only that, there's certain qualifiers that I've created throughout the years to perfect the trend lines." And he said, no, I've used your qualifiers, use this and that. So I took a look at what he had, from the audience he showed me, and it didn't look right. So the only conclusion I came up with is that he wasn't using the qualifiers properly, and he wasn't drawing the trend lines properly. And that proved to be the case. Now let me just show you. I've got a certain way of drawing the trend lines, which I'll get into. But I'll show you just using the basic approach, identifying the points. Obviously, to construct a trend line, you need 2 points. I'm going to use that basic approach, but I'm not going to use the qualifiers. I'm not going to use the perfection, the other techniques which perfect the trend line. And I'm going to show you how difficult it is, even as a floor trader. Now, this is going to be a daily chart, like I said before. And just let me digress for a second. Why am I using daily charts? There are 3 reasons why. First of all, most people, if you had to take a common denominator, most people trade on a daily basis. The data, as far as daily data, it's generally correct. You make an intraday data, you're trading based upon intraday data, and all of a sudden there's an out trade, or a trade's been deleted. And you've entered a particular trade because of that, and you're not dealing with a machine in front of you. You're dealing with a broker. So you got a potential problem there. Plus, there's an awful lot of slippage. There's no guarantee if you go back and try to retrofit your system to see, or test your system to determine whether there's any validity, that an intraday signal or entry point would even be capable of being filled. So that's why I use the daily data. But I'll show you here in this particular example. Here's one that was in the book, but I can also refer to Rick's machine. This is something that I just drew randomly. If you had someone draw a trend line, like I said, there'd be all different ways to draw it. And most people, just by human nature, draw the best fit. Doesn't mean it's correct. And in this example, I only drew 3 lines. I know there's a basic tendency to people to trisect up moves. They use 3 trend lines. They say if you, most market timers, a number of market timers will say if you break the first trend line, you go to the second one. The second one's broken, you go to the third one, then you'll break. It's just an excuse. There's nothing definitive there, and it's a guess. So like I said, most trend lines are drawn, and most of them are drawn from left to right. And I found that what you want to do is look at the most recent price activity and draw back to history. So it's tough to do it. I mean, there are a lot of things that just by human nature, you're almost programmed to do by some template, which has been, which is in most traders to draw left to right. It's just not right. At least from my research, it's not. Now, if you take a look at this example of cotton, I've drawn arbitrarily 3 trend lines off the February 92 low. And the same thing happened if you go to the May low. But there's quite a few more. Now, if you refer to the CQG machine, I'll cite some other example. I'll show you what you're up against. Now, here's just live cattle, 1994, December. You can see here the number of trend lines. This is just using my technique of trend line construction. Now, we haven't gotten into that yet, but I'll get into it. But it shows you how many there are. I think you've got to, first of all, create the trend line, draw the trend line, and after you've drawn it, then you've got to perfect it somehow with qualifiers. So you've got to reduce this mess that you see on the machine to legitimate trend lines that are going to reward you and hopefully make you money, by making money. Now, what I want to get into first is something which I call TD points. Now, like I said earlier, in order to draw a trend line, you need a line, any line, you need 2 points. And in the case of a supply line, a supply line being a line in which prices are declining. So assume prices are declining. This is called a supply line. And it's called a supply line because price is being offered for sale because a particular commodity or particular market, particular stock is being offered for sale. As a result, prices are being depressed and they're selling off. So that's a supply line. Now, conversely, a demand line would be an ascending price structure, something like that. So you got your demand line, which is moving up, and your supply line, which is moving down. Okay? Now, like I said earlier, in order to construct a trend line, you got to define 2 points. Now, how do I define the points? What I've used in the past, something which I call pivot points, call them now TD points. And by the way, most of the items which are in the book, as well as I'm going to discuss today, have been trademarked by me, copyrighted, so I've got some ownership to them. But I label them with my initials because I think I've uncovered these ideas. In this particular case, you've got a peak in price. Now, like I said earlier, assume these are daily ranges. You've got a high up here, and at this particular high, prices turned down. And you can see the day before the high, you had a lower high here, and a day succeeding the high, you had a lower high. So I would define a TD point, which is one component of a TD line. Like I said earlier, you need 2 points to construct a line, a TD line. That particular point would be defined here. This is a supply point right here. Prices ran into resistance, and as a result, price decline. Now, once you've established a subsequent TD point, supply line, which is right here, you got the ingredients there or the requirements necessary to draw a trend line, to draw a TD line. See, what you've got in this case as well is a high in which price met resistance, a lower high the preceding day, and a lower high the succeeding day. Now, subsequent to these 2 points, you also formed another TD supply point right here. You have a lower high and a subsequent lower high. Now, like I said earlier, most people are accustomed to drawing a trend line from left to right. So in this particular case, a naive trader or someone who is not informed in the techniques that maybe I've created throughout the years would draw the trend line. Assuming he did identify the pivot points properly, he would draw it from left to right. Just accustomed to do that. What I'm saying, do it a little differently. Look at the most recent supply point, which is right here. Connect it with the second most recent supply point. You can even draw from left to right here, but you got to connect those 2 points. And what you've got is a TD line here. Now, what I found throughout my experience in the market, that supply-demand is in a continuous process of flux. You know, on a particular day, this first TD supply line, defined the trend in the market. Well, all of a sudden, maybe some news came out. Maybe some big seller came into the market. Maybe, it could be so many variables, and you don't really care. As a market timer, you're almost a parasite. You're following the market itself. The market's speaking to you. It almost lives and breathes and has a life of its own. In this particular period of time, the market said, hey, the supply-demand equation is changing. I've got a supply point right here and a supply point right here. This one here, forget about it. This supply point is no longer important. So you got the 2 most recent. Now, say, for example, you formed another supply point right there. You would redefine the line. Okay? So you redefine it. Now, once the market rallies and breaks above the line, that's when you derive the benefits from these supply lines. Now, let me show you with the CQG service how these particular points are defined. Well, do you want to go to
in here?
No, let's go to the TD points.
TD points, certainly.
See, what you could do is you could highlight them. You can go through them yourself. I prefer right now, obviously. I never had this luxury with the computers. Whether it's CQG, FutureSource, Aspen Trading, or Bloomberg. I never had that luxury. Now I can have the computer do it for me myself. I would do it in the past. I would go through the chart, and invariably there'd be an error. And I wouldn't realize until after I entered a trade. I'd say, oh, I screwed up again. Unless you do it very meticulous, you have someone almost check your work to determine, if it's a valid point, invalid point, the most recent 2 points. Now you can see on this particular chart, if you move the cursor up here, the TD points are defined with numbers. Now, if the day before and the day after are lower than the middle day's high, you obviously have a TD point. Now, what happens when the 2 days before and the 2 days after are lower than that middle point? You still have a TD point, but you've got what I call a TD level 2, because you've got 2 days before and 2 days after. Now, level 1 is where I usually operate. I like to go to level 2, level 3, and I'll take you through that here to give me some direction, some overall market environment. So I'm operating in the context of the market. I like to use maybe the 2 or 3 level. When I identify a breakout there, I like to take it down to the next, to the 1 level, and I want to make certain I'm moving within that context. But you can see here, a number 3 is defined up here, and what that means is you got 2 lower highs succeeding that peak, and you've got 2 lower highs preceding that peak. Here you've got a low, which is the converse. You've got a low with 2 higher lows the 2 preceding days, and succeeding days you got 2 higher lows. Now, if you go to here, well, here's a 9, and just the way this computer software has been created is a 9 would satisfy the requirement that you have 9 higher lows preceding, 9 higher lows succeeding, but it could be more than 9. They just don't use double digits. But you can see, once again, you got a TD point, but it's only a 1. And the reason being 1, you have a high here surrounded by previous day's lower high, succeeding day's lower high, but unfortunately, 2 days before, it was higher. So that's why it's only a level 1. Now, if you go back in time, you have a level 2 once again. And the reason being level 2, well, you've got to move it to a little more to the left. Okay, right there. This is a level 2 low because 2 days prior are higher, 2 days succeeding are also higher, but 3 days are not. So that's why a 3 doesn't appear there. So at least you get an idea how to identify the different basic building blocks, which are TD points.